Okay, hello everyone. This is John Hardy, head of FX strategy with Saxo Bank. If you're having any immediate problems with the sound, please pop that in the chat. If everything's okay, you don't have to put anything in. I did a sound check a short while ago that some of you were here for. Yeah, so we're having a little chat today about the forex market once again. I think some interesting things going on, and we have actually some ECB minutes coming out here as I am speaking, so I may be a little bit distracted at a couple points to see if I can get anything, pull anything away from the headlines coming out of that as we go through this presentation. But otherwise, I wanted to talk a lot today about two things. One of them is in the title of this presentation, the dollar outlook and some U.S. dollar catalysts that I think are very important, both short-term and long-term, because I think the dollar view is very important right now, and quite some interesting levels and technical on the charts as well. And then the Japanese yen, most of that, or a lot of that on the chart, signs of potential pending yen strength. First of all, though, small order of business, anything I say here today is simply my thoughts on the market and where things may be headed and should not be taken as a direct trade recommendation. So please keep that in mind. The other thing is, if there are any questions of any kind related to the forex market, I would hope, during the presentation, rather on a particular slide, or before I head off to the charts, please do let me know. I'm trying to do this in a bit more of a compact time format today for a number of reasons. So I may be a bit quick to cut you off if you don't get those questions in there towards the end of the presentation. Just a small warning there. So let's get into it. Key themes across the FX market. The whole central bank convergence versus divergence theme. We've had a little bit more Fed hawkishness of late, the rate comparisons, the rate spreads moving in the dollar's favor quite a bit, and this was after a very long and brutal consolidation in the dollars. We have seen a decent dollar bounce, but it's nothing that's exactly torn our hats off. And we're wondering here, we have a longer term view of dollar weakness now, and what we're wondering now is, are we at the inflection point where we go back to the longer term trend, or is there a bit more steam in this rally? And I don't think the markets know that. I'm not sure we know that either. And there are a couple of things that I think we'll need to have in place before we can know whether there's potential for that rally to extend. And the uncertainty here could stretch out for a while, especially on Washington and the political process in the U.S., because Trump tax reform is a key component. Yeah, and then elsewhere we've seen a lot of interest in the convergence trade with a very strong upgrade in the Bank of Canada's rate view, for example, an actual couple of rate hikes they've managed to carry out. Bank of England even managed to get slightly hawkish for a few seconds anyway. But those moves have sort of pulled back, especially in a relative sense versus the U.S. So we haven't seen a strong central bank theme emerging over the last couple of weeks. And now one interesting thing, and I'm especially going to point this out on the charts, is our interest in the potential Japanese yen upside, as we're seeing a bit of, again, a few moves on the charts, and we've seen a bit of resilience in any case, despite some of the recent rising yields, and now yields are a bit back lower, so we think something could be shaking there. Now, as part of the dollar outlook, of course, we need to consider the U.S. economy. This is in a week here where we had some incredibly strong ISM manufacturing and non-manufacturing numbers. The manufacturing survey was the second strongest number, I think it was, since 1987. But if you look at how this survey does around hurricane months, we've seen again, we saw back in 2005, if that was the reason why, that just post Hurricane Katrina, we saw a very strong bump in this survey for a couple of months. So that is clearly a driver there, and that's been explicitly pointed to in the coverage after that figure. Now, normally the non-manufacturing survey, there's not much of a normally to go on here. Again, very few data points. But if we take the 2005 experience of the ISM non-manufacturing, it spiked remarkably to actually the last time it was above current levels, if I recall, the month before Hurricane Katrina in 2005, and then collapsed 5 points the next month. And of course, it wasn't just Katrina; it was also Rita. And this time we had two hurricanes as well. I would have thought maybe we would have seen a weak number this month and then a stronger number in the recovery month on this, but that has not been the case. But I think there is a risk of a drop-off in the non-manufacturing. And there are a number of other points pointing to weakness in the U.S. consumer. We got auto sales down, perhaps some wobbles in the new home sales market. which is one of the more leading indicators there. Retail sales haven't been very impressive. This was an interesting one, the Philly Fed survey. They look at whether this is taken from this calculatedriskblog.com, where they show the number of states showing increasing activity, and you see this this is going down quite steeply in previous instances when it's been this low. That's often led to been a forward indicator of recession. So we'll keep our eyes out on that and our worries on whether the U.S. economy is not doing so well. But the thing occupying markets is not so much the economy, and plus we have all this concern about how much is the hurricane affecting this last batch of data and even the next month or so. And it's more about who is going to replace Yellen, or will it be Yellen herself at the Fed, and I'll have some coverage of that. Very important there. I'm not sure we'll know what the Fed policy will be, even if we know who the candidate is, but the market has some built-in opinions and it's going to react inevitably. And then we have tax reform, which has come back from the dead. Really, there was zero expectations of the Trump trade ever manifesting, and the speculation was more on how many days does this man have left in office before he's impeached. That may still be an open question, but his working together a little bit with the Democrats and managed to avoid, at least to some degree, avoid fresh controversy and put tax reform on the agenda. And the Senate and the House of Representatives moving forward with trying to put together some kind of budget resolution has this anticipation in the air as well. And in this process, again, it could go on for quite some time because of the slowness of Washington. And I think the Senate deadline is November 12th, if my memory serves, but in November anyway, for the outlines of what their response to Trump's tax plan could be. And anticipation is there that it would prove dollar supportive. I think we'll get something that's a bit watered down, but let's look at that as well, and other things to consider if there is tax reform. And then all eyes on China. I've talked about this a lot last time, so I don't want to cover that this time because I think that those comments, I would just be repeating myself there. And this is a slide actually I have repeated time and time again, but it's important to consider as well. Again, the QT, the quantitative tightening from the Fed, is going to mean around, if they remain on schedule, another 1.5%-ish of deficit, because those bonds that roll off will have to be refinanced by the U.S. Treasury by issuing new bonds into the market. So that alone puts us at 5%. If anything approaching Trump's tax reform is put in place next year, we could be looking at another percent, plus or minus, on the deficit. You're talking about a 6% deficit, and who is funding that deficit is my big question. It's the world's largest economy, and at 6% of GDP deficit in a world where central banks are not interested in building dollar reserves anymore. I think that is a powerful dollar weakening signal for the longer term, even if there is some excitement short term about dollar flows on Trump tax return, repatriation flows, what have you, interest in U.S. assets because of lower corporate tax rates, maybe some inbound investment flows by U.S. corporations, etc. Now, I want to spend a little bit of time on this slide just to consider the different Fed candidates and the probability. I'm not sure how much quality I can add to the debate. I think those commentators that I agree with most are the ones pointing to who is going to be the one that supports Trump's pro-growth agenda and is not going to be a hawk, which is supposedly seen. There's been a lot of talk of this Kevin Warsh being one of the favorites, but if he is remotely hawkish, if he hasn't sold himself well or properly, and is insistent that he would like to hike rates and is worried about asset bubbles, I think he's going to prove less likely to become the next Fed candidate. Speaking in his favor, however, is his personal connections with Trump. His father-in-law is a very close associate or a friend, at least, or business, basically a personal friend of Donald Trump that could raise the odds there. He's also embarrassed himself in the past during the initial phases of QE and the Fed's response to the global financial crisis. He was on the Fed Board of Governors. He was very instrumental, apparently, in helping to convince lawmakers to do the quote-unquote right thing, and all the emergency measures aimed at shoring up the risks to the economy and to the entire financial system. However, he really was very early in calling for rate hikes and massive concerns about inflation. Already in mid-2008, when the heart of the crisis was still burning bright, and that proved to be quite disastrously wrong. So that's an interesting part of this to consider uh, in terms of his candidacy. Now, Cohn, there are a couple of things there. On the plus side, he is working close day to day with Trump, being on the National Economic Council head. He's very pro-growth. He's very currency war minded, which is, I think, is one of Trump's key themes. So therefore, he would be seen as dovish. So if the market is going to react on the headline of a Warsh nomination, dollar positive, the immediate of the favored, perhaps three candidates, this is the most dollar negative, Gary Cohn. On the negative side, he's of course this flap over Charlottesville and Trump's response to that, which saw apparently Mr. Cohn considering resigning, and some behind the scenes furor there. Could lower the odds if he's not seen as a lawyer, player, etc. But I'm not sure how much that counts now that it's been some time since that situation. I think it's either Cohn or Powell that are most in the running. Powell, he's on the current Fed Board of Governors, so he's perhaps the easy choice in terms of continuing to less risks of discontinuity from the markets. He's a known quantity. He's pretty much the middle of the road in terms of hawkishness or dovishness. Apparently, Secretary of Treasury Mnuchin likes Mr. Cohn quite a lot. I'm just noticing the one person having a problem with their sound. I'm sincerely hoping, and that's not the case for everyone. But please speak up, obviously, if there are any issues. If you can't hear me at all, I would wonder why you're still here. But in any case, drawbacks for Powell could be that he's a bit less on the anti-regulation front relative to especially Cohn and perhaps Warsh. He sees maybe some room for some optimization. One of Trump's key themes is massive deregulation, so that could be maybe speaking against his candidacy. I don't really know. I think he's a more neutral candidate relative to the more dollar weak extreme in Cohn and dollar strong end on Warsh. The lower odds candidate is Yellen herself. I really don't see why there would be a reappointment of Yellen. Doesn't make sense. I think Trump wants to make a statement at least of some kind. And I'm not entirely sure she wants to run herself. Not to mention the whole confusing message of we don't really understand why all of our models don't work. A message that we've seen peddled by Yellen lately. And then an outsider. This was mentioned by hedge fund, the hedge fund, double-line hedge fund fame. Gundlach, Mr. Kashkari of the Minneapolis Fed. He's been the dissenter to both of the Fed rate hikes this year. He's very dovish on rates, but he's also one of these. Supply-siders, and almost all of these candidates are supply-siders. And I actually don't really find them very interesting beyond the first blush of the market's reaction, because they're all talking about deregulation and supply side, as if that's the problem, and it's not the problem. The problem is the demand side of the economy. When we have the next recession, market disruption, what have you, and I don't think we're seeing any of them talking about the merits of helicopter money, which is the inevitable road we're headed down towards, especially in an era of increased populism, when it's the answer to populism from a policy standpoint is not QE and monetary policy, it's QE as an adjunct to fiscal policy and helicopter money to distribute money to the masses. And in that sense, beyond the short-term blush of things, I'm not sure we have any answers at all from this menu of candidates. So we talked a little bit in my intro slide about reconvergence, the reconvergence trade, and what I mean here is that this is the 10-year spread in yields of the U.S. dollar versus Canada, which has been inverted, but just to get the dollar on the right side, versus Canadian dollar versus sterling in orange, and against the euro in white. So we saw the euro rates and sterling rates rising relative to the U.S. Canada, especially so with that big change in the outlook. And that saw a pretty big repricing this year in the U.S. dollar. And the latest bit of dollar strength has been seen by the dollar, making a comeback in the rate spread sense. So, and how much further does this have to go? I would say modestly so on maybe a bit of U.S. economic resilience or the Fed appointment or nomination process, etc. But the general tendency we don't see shifting here. The only route we see to dollar strength is not from this source. To a bigger dollar strength is not from this source. It would be more from a dollar liquidity problem with offshore dollars and other things that I've talked about previously as well. Economic calendar, by the way, Fed's Powell, one of the potential nominees for the new Fed chair, out speaking later today with a Q&A, so it could be interesting if he let's drop with any sort of big picture type of analysis. Of course, he's not going to say anything about whether he talked with who and what the likely odds are of his becoming the next Fed chair. And then we have ECB minutes, which apparently generated insufficient headlines, not surprising me much, to move Eurodollar more than about 6 or 7 pips. So I'm suspecting we're not going to get anything until we get the next ECB meeting towards the end of this month. Possibly not even until December if we're talking about the actual schedule for the taper. And already the market's looking at some kind of drawn-out tapering process before rate hikes begin even further out. And what is the real big shift there? In terms of reality of what they announce versus expectations, I'm not sure the drama is that particularly high. So, and then, of course, we have the latest payrolls data, and the market could be sensitive to an earnings rise beat, but really the U.S. dollar outlook is all about this tax reform speculation, and of course the who will become the next Fed chair. Japanese politics getting increasingly interesting. We'll talk about that more at our next webinar, as it'll be shortly ahead. And then cyclically and policy-wise and global growth-wise, a ton of focus for good reason on the Chinese 19th Party Congress and their attempted shift long-term, which is the key, away from a investment-intensive and savings-intensive economy to one that is more looking towards consumption. And how will they make that shift and also deleverage their economy? Important questions there. So I've covered that, and then on the dollar, I think I've covered that as well. There's a bit of confusion short term over the data because of the hurricanes, and it's the policies, it's stuff that we're looking for next, and Fed chair replacement. On the yen, we'll look at the charts. I think that's the most interesting thing right now. We're seeing a little bit more resilience to rises in yield. And yields are actually back a bit lower, which supports the yen anyway. The Japanese economy is absolutely booming, and we're getting up soon in the coming quarters to some technical limits on the Bank of Japan's purchases. So there could be some kind of inflection point here soon. And we'll look at the charts again, as I said. Euro, I think longer term, looking for the euro to continue to strengthen and reprice higher versus the dollar, whether we have a consolidation extension in Eurodollar, for example, down towards 115. Euro yen could also be an interesting one for some euro downside. I'm not quite sure, and that's still possible. But longer term, looking higher with again the tactical uncertainty. Sterling, the divorce bill situation still hanging over the Brexit negotiations and holding it up from progressing to the next phase. We need to see that divorce bill amount established, agreed on, and squared away and move to the next step. And we need to see the Bank of England hiking rates in November, I think, to see the sterling put in a floor here. It's really disappointing here, some of the levels the sterling's going through against the dollar and the Japanese yen. So it's really on its last legs here if it's not to avoid a complete sort of failure back into the old range here. On the commodity dollars, China policy will be extremely important, and also it's not going to get any kind of durable, I think, trend or direction until we have some kind of crystallization of what's going to happen to the key commodity prices for Australia. For the Kiwi, more short term, we have a lot of drama over this election. The election results have not even been tallied yet with the strange system they have. That will happen this weekend, and then we have a kingmaker in the New Zealand First Party, which can choose between if it wants, can choose between making a government with Labour or the National Party, the more conservative National Party, and that is, of course, two very different outcomes. So I think you've got a lot of binary risk one way or the other for Kiwi. And Kiwi dollar looking at some very important downside pivots right here. So I think that's an interesting trade. I think that my general feeling is Kiwi risks are lower. And then on the Scandies, NOK is really just uninteresting now. There's no rate view or rate to anything, altering the rate outlook for Norway, and we have the oil prices that were higher, potentially providing a story for NOK upside, but that's been tempered by this latest sell-off, and oil is trying to get boring again. So Euro NOK is doing the same. Euro Stocky a little bit more interesting after the Riksbank governor was reappointed. We saw a stocky spike lower, and that's stocky spike because he's considered one of the super doves among central bank policymakers. And but that was quickly unwound as he said in his a luncheon shortly after he was reappointed that he's happy to see, or wouldn't be surprised to see, some krona strengthening as long as it's fairly gradual. So sort of an admission that the krona is very cheap, and I think the general direction will be upside versus the euro, but nothing dramatic, and it'll be a grinding process. And anytime it gets slightly even ahead of itself, you'll see this cautious rhetoric from the Riksbank. And emerging markets are not enjoying a stronger dollar, and they haven't enjoyed the big backup in yields. If the yen is about to strengthen as well, I think that could provide a challenge. So long term, we like EMs. They've shown signs in a bigger picture sense of some resilience in the recent cycle. But I think maybe near term, some pressure there and some better entry levels to be found if we're to look at EMs as a group. Okay, so I have about 9 minutes to look at. We have a very kind comment from Mr. Ashton. Thanks for that. Are we seeing the death of the dollar as the reserve currency? Yes, we are seeing that longer term, but this is not something that happens all in one go. And that's a process that I've talked about in the previous webinar, which is available on tradingfloor.com. You can just go back and see it from a couple weeks back. I had a long discussion on this idea of the petro-UN, etc. Okay, so I think I'm going to head off to the charts, and I will do that quickly here. Okay, so here we have the euro dollar, and this week we saw a minor. We saw the new lows of the cycle below 117.15 or whatever that minor low was, and that was rejected. But the rejection didn't have much energy. I think it's due to all this uncertainty about the Fed chair, about the U.S. economy, because we don't know how to interpret some of the data on the hurricane data, and Trump tax reform. But it still looks heavy, but it's a bit of in limbo here. If we do break lower, especially below 116.70 or so, I think we could be headed for a bigger extension down, possibly towards the 115, even 114.50 area, which was pivotal on the way up. To me, that's the sort of the extent of what I'm comfortable with being a longer-term dollar bear. If it's getting beyond that, I think we have to start asking questions. But just given how extremely far we have come in the bigger picture, we do have some room for a decent further consolidation without turning the tide in terms of the trend higher. If we go to, I want to take a brief look at dollar Swiss. This was a trade we did this week, and unfortunately I raised the stop and then got stopped out at the raise stop. So the comforting thing was that it was a small loss. The uncomfortable thing was that it was almost a low of the day and it's come back higher again. I think a lot of drama here. This is pretty interesting, this 97.75 area. It was broken briefly. That break was rejected, and then now we're poking back on these levels again. I think if it does break higher, and that would, of course, coincide with some euro-dollar downside, we could be heading back up into this range to parity and maybe even 101. And that would be supported by Euro-Swiss heading higher as well, which it is not at the moment. So I think part of that due to the flap over Catalan, some of the spreads in Europe a bit wider. They came back in today. There was a very solid Spanish auction that showed that at least Spain is not having a hard time at all in peddling their sovereign debt. Now, I wanted to spend a little time on sterling as well because of the technical developments. We have this breakdown through the old high, which is uncomfortable for the bulls that were looking for this trend to extend. And the sort of the last ditch argument you can make is the 61.8% retracement and the low 131s on this move higher. But to me, the breakdown here is starting to look quite ugly for the risk of of full retrenchment back into the zone, maybe even to the 200-day moving average at 128, unless we get some kind of fundamental catalyst that puts us back on track to the upside. So looking very heavy there, and again, if it extends through 130, 110, it's starting to really fully wipe out the prior rally. Euro sterling, we have so far the retracement has been a fairly polite retracement. After a very considerable sell-off, a lot of that on the new tone from May on Brexit, as well as the Bank of England, I think, playing a very key role there. Here we have the bigger rally. I think I'm a bit more interested in the retracement from the highs. So far we're only looking at a 38.2 even, and that's not even coming to view yet. 89.60 or so. I think 90 to 90.91, which is the 61.8, is allowable, and we still consider it the potential for a trend turnaround back to the downside. Again, wiping out this entire last extension was quite an achievement. But we need to see this retracement stopping short of these last Fibonacci's to suggest that we're to continue to focus lower, which I would prefer to do. But again, we need to see some clearing on the Brexit front, and we need to see the Bank of England moving into a rate hike mode. Now I'm going to switch to my Ichimoku charts for a couple of yen charts. Quite interesting there. And here's Euro yen actually, which is interesting developing today. We have not so much on the cloud here, but this prior high, 131.75 or so, or 131.70. We saw an extension above it, and then we came back, and that was where it found support. And the subsequent rally is not impressed, and is looking heavy to me. So I think if we're pivoting through this level, we're starting to see a bit more broad interest in yen strength, again on the strength of the Japanese economy. And as we look towards the election and fiscal potential for fiscal stimulus, inbound investment, etc., we could be seeing it retracing quite a bit. And another chart that's a bit more advanced, if we're to talk about in breakdowns in some of the yen crosses, is Aussie yen, where we've seen this false top. I believe I've covered this previously. A very nice outside day rejection after these new highs were posted above 89.50, and then we posted a minor pivot area here where the action stopped, and now we're looking at breaking through that pivot. Of course, we need to see the close today and perhaps for the week, but this does look like a confirmation of the topping formation. And dollar yen, could be seeing dollar strength and yen even more so strength. We'll be focusing on the Ichimoku cloud levels, which were the prior support when it consolidated a bit here recently. So keep those levels in mind as it gets down towards 111.50 and slightly lower. If it breaks into the cloud, then you go to the bottom of the cloud for the next support, or looking for Fibonacci levels. And then finally, I'm running out of time here, but I'm going to look at Aussie and Kiwi, especially I think which are getting into some key levels. For me, the Aussie dollar, the 78 to 77.50 zone looks like the main pivot zone. So we saw this considerable rally above the more recent high around 77.50, and then above the longer term high, which I really have to stretch out the chart to show, at about 78.35. Tested once, we tested again and survived that test. We haven't fully broken down, but if it's getting back below this level here, then we're talking about a bigger breakdown into the prior range towards 75 and even lower. Notice the 200-day moving average creeping up as well. So, it's decision time for Aussie soon. Are we this is the bull bear pivot zone, I would call it, 77.50 to 78. And Kiwi's even closer to its sort of breakdown zone on this election uncertainty, and if things fall the wrong way, we could be headed again further back down into the prior range. The topping formation there a little bit more profound, and that's been on this sequence where it tried to break above 75. That was quite heavily rejected. Saw a throwback rally, and that's being rejected. So you can call this 71.30 area and the 200-day moving average, which has crept a bit higher, sort of the downside pivot here for a full surrender back into the old range towards 60. Yeah, and now we'll go back to our presentation, and hopefully I covered any pairs you were interested in. If you have any questions, you're more than welcome to add those to the chat. at any time in future presentations. And slight apologies for keeping this a bit short this time. I have some time pressures elsewhere. Oh dear, the wrong screen was shared. Well, that's probably because I just had my that's you'll have to forgive me, and hopefully the audio you could follow along which charts I was talking about and see the levels. That's we just recently moved computers, and I'm sure the designated computers are screens are not ordered in the way they were used to. So I'll have to investigate that for the next presentation. So I do apologize. I do apologize for that. Okay, thank you for this time around, and I hope you found it useful, and I hope you'll be back for future versions of the webinar. And keep an eye on the local Eurodollar support, and keep an eye on these yen crosses. I think that's where technically the most interesting things are happening right now. And again, apologies for the charts, but I think if you had, even if you replay this recording, and you pull up the charts that I was talking to, you can see the levels for yourself, of course, just without my, unfortunately, without my cursor showing what I was talking about. So, all the best, and careful, safe trading out there, and we'll see you next time.